Welcome back. When most people picture retirement, they imagine freedom. Freedom to travel, spend more time with family, and enjoy the life they've been working toward for decades. Finally, all that savings and investing has paid off. But what often surprises retirees is just how many rules surround those savings, especially once you reach age 73. That's because at age 73, the IRS requires you to begin what's called a required minimum distribution, or RMD. And this is not optional. The government requires you to start pulling money from certain retirement accounts, whether you need the income or not. And here's where the challenge begins. If you withdraw too little, the penalties can be steep. If you withdraw without planning, you may trigger more taxes than necessary. And if you don't coordinate these withdrawals with Social Security and Medicare, you could end up paying more in premiums and taxes than you ever expected. So turning 73 is a milestone, but it's not just another birthday. It's a turning point in your retirement plan. And depending upon how you approach it, it can either add stress or create opportunity. Hi, I'm Hank Persia, President and owner of Starboard Wealth Advisors. I help high net worth retirees and pre-retirees turn their savings into reliable, tax-efficient income so they can retire with clarity and confidence. If you're approaching retirement or already retired and want to make sure your income is working for you and not against you, click the link in the description below to schedule a complimentary consultation. I'll walk you through your options and help you put a plan in place. In this video, we're going to break down exactly what happens at age 73. We'll look at what RMDs are, how they're calculated, the mistakes that cost retirees thousands, and the strategies you can use to manage RMDs in a way that preserves your wealth. Let's walk through it step by step. Part 1. What are RMDs? Required minimum distributions, or RMDs, are the government's way of saying it's time to start paying taxes on your money that has grown tax-free for years. They apply to most tax-deferred retirement accounts like traditional IRAs, SEP IRAs, simple IRAs, 401ks, and 403bs. For decades, you've likely contributed pre-tax dollars and watched those savings grow tax-deferred. That tax break is powerful, but the government won't let it last forever because the IRS has a basic rule on taxes. Pay me now or pay me later, but you have to pay me sometime before you die. And age 73 is the point when mandatory withdrawals begin. There are a couple exceptions worth pointing out though. Roth IRAs are exempt from lifetime RMDs. That's one of the reasons why they're such a powerful tool. And thanks to the Secure 2.0 Act of 2022, Roth 401ks are also no longer subject to the RMD rules. Part 2. How are RMDs calculated? The math behind RMDs is straightforward, but the implications are important. Each year, your RMD is calculated by dividing your prior year-end account balance by your life expectancy factor provided by the IRS in publication 590B Table 3 to be specific. Here's an example. Consider you turned 73 this year. On December 31st of last year, your IRA balance was $1 million. According to the IRS tables, the life expectancy factor at age 73 is about 26.5. So if you divide 1 million by 26.5, you get an RMD of around $38,000 or 3.8% of your account value. That's the total amount you're required to withdraw by December 31st of this year to satisfy the IRS rules, either as a single withdrawal or the total of smaller withdrawals. And every year going forward, the calculation changes slightly. The percentage you must withdraw increases gradually as you grow older and your life expectancy factor decreases. That means as you get older, your required withdrawals become a larger percentage of your account balance, up to 8% at age 90. Also, for someone with multiple retirement accounts, this calculation can get complicated. With IRAs, you can total up all accounts and withdraw from one or several as long as you meet the total requirement. But with 401ks, each account has its own separate RMD. Overlooking that distinction can create an expensive penalty, especially for 401ks left at former employers. Part 3. What happens if you don't take your RMDs? The penalties are the part that catches many retirees off guard. For years, the penalty for not taking an RMD was 50% of the amount you failed to withdraw. Again, with Secure 2.0 Act, that penalty has been reduced to just 25%, and in some cases can be lowered further to 10% if the mistake is corrected quickly. Even so, it's still significant. Going back to our earlier example, if your RMD was $38,000 and you failed to take it, the penalty could be more than $9,000, plus you still have to pay taxes on the RMD withdrawal itself. Missing an RMD isn't something you want to deal with, and the reality is it's avoidable with proper planning. This is why many retirees set up automatic withdrawals or schedule them earlier in the year so they're not scrambling at year end. Especially before age 73, it's also a good idea to consolidate or roll over old 401ks or multiple traditional IRAs into just one traditional IRA, so the RMD calculation is based on just that one account versus worrying about multiple accounts RMDs. Part 4. The tax impact of RMDs. Taking an RMD isn't just about satisfying a rule, it has a ripple effects across your entire tax plan. So every dollar withdrawal counts as ordinary income. That means it stacks on top of any other income you already receive, like Social Security, pensions, dividends, or interest. And as that taxable increases rises, three things can happen. First, your marginal tax bracket may increase. What looks like a comfortable retirement income plan can suddenly tip into a higher tax bracket once RMDs start. Second, more of your Social Security benefits can become taxable. Up to 85% of Social Security can be taxed, and larger RMDs often push retirees into that range. And third, higher income levels can trigger the Medicare Income-Related Monthly Adjustment Amount surcharge, affectionately known as IRMAA. These surcharges increase your Part B and Part D premiums. For high-income retirees, the difference can add up to thousands of dollars per year. This is why RMDs are not just a tax formality, they are a central piece of retirement tax planning. Part 5. 5 strategies to manage the added RMD income. So what can you do about it? While you cannot avoid RMDs completely, if you have tax-deferred accounts, there are several strategies that can help you manage them more efficiently. First, consider Roth conversions before age 73. Converting portions of your traditional IRA into a Roth IRA in your 60s, when you may be in a lower tax bracket, reduces the size of your traditional IRA and therefore lowers your future RMDs. Yes, you'll pay taxes at the time of conversion, but you're often trading a smaller tax bill today for lower required withdrawals and potentially tax-free income later. Second, take advantage of qualified charitable distributions, or QCDs. If charitable giving is already part of your plan, this is one of the most tax-efficient ways to do it. Starting at age 70 and a half, you can begin making QCDs directly from your IRA to a qualified charity. In 2025, up to $108,000 per year can be transferred in this way, and it counts towards your RMD without adding to your taxable income when you have to take RMDs. It's a strategy that allows retirees to support causes they care about while also keeping taxes lower. Third, consider taking withdrawals earlier. This may feel counterintuitive. Why pull money from an IRA before you have to? The answer is because spreading withdrawals over multiple years can keep your taxable income steadier and avoid large spikes later on. For example, a retiree who stops working at age 65 may have a window of several years where income is relatively low. Using that period to make smaller withdrawals can reduce the burden when RMDs start at 73. Fourth, be intentional about which investments you use to satisfy your RMD. Not all withdrawals are created equal. If markets are down, you may not want to sell stocks at depressed prices. Instead, you may withdraw from bond holdings or cash reserves, allowing equities time to recover. On the other hand, in years where markets are up, trimming appreciated positions may fit better. Coordinating your withdrawal strategy with your investment allocation is one way to avoid unintentional losses. And fifth, coordinate your RMDs with all of your other income sources. This is where comprehensive financial planning really matters. Social Security, pensions, dividends, and required withdrawals all interact. Without a plan, you can easily push yourself into higher tax brackets or trigger the IRMAA surcharge. With a coordinated strategy, you can smooth out these income streams, keep your taxes lower, and make your portfolio last longer. Age 73, requirement distributions are not optional. They're a reality for anyone with tax-deferred accounts, but just because the withdrawals are mandatory doesn't mean the tax burden has to be. With proactive planning, whether through Roth conversions, charitable distributions, smart timing, or coordinated withdrawals, you can make RMDs just one part of a thoughtful retirement income plan. Please note, this video simply presents an overview of RMDs, but the IRS rules can get a bit more complicated depending upon your exact situation. If you're approaching RMD age and want to make sure your plan is working for you and not against you, click the link in the description below to book a complimentary consultation. Together, we can walk through your options and build a strategy that fits your retirement goals and preserves your wealth for your family. Remember, at Starboard Wealth Advisors, your financial destination is why we're here. Thanks for watching, and if you found this helpful, make sure to watch our other videos for more clear, no-fluff retirement guidance, or contact us for a simple phone or Zoom call. Thanks for watching, and hope to see you on our next video.